Joining me today, returning first time on Market on Close, Bob Iaccino, founder and chief strategist. Bob, it's good to have you back on the show because last time we were talking about crypto. There's been a lot that's happened since, but the market here continues to give us other stories as well. We've also got Scott Connor, our head of trader education here, as well as Victor Jones, co-host of Swim Lessons. So guys, I want to start things off, Bob, with the conversation about active versus passive managers. We hit this a little bit yesterday ahead of BlackRock earnings, but we also got some news again today. Another fund closed down. T. Boone Pickens, legendary energy investor, hanging it up. I mean, also he's been around for a long time too, but this is still fitting into that narrative of lots of closures that are still happening here, even despite a pretty decent year for active managers.
Yeah, I've always had the same sort of opinion on active versus passive. To me, passive management, when you hear these conversations of passive can't be beat in terms of total return, those are right. I mean, there's no arguing that. Yeah. But the argument I always have with people is, how did you do on the downside passive? I mean, obviously you match the index. And active, the whole idea is to outperform on the downside, not on the upside. Yeah. It's actually to mitigate risk. So the way we do it is we have obviously personally a ton of passive on our own. Okay. But the active we do is a percentage of the portfolio we try to outperform on. Okay. And that particular percentage of the portfolio is the difference maker for us as we're matching everything else in passive. We try to outperform more on the downside than the upside.
Okay, so the investment philosophy at Path Trading, let's talk about the big investment philosophy, which has been one that's been tough to be an active manager, or at least as the side for the active management portion of your portfolio. Because Scott, this has been a market where everything has moved in lockstep. The gains have been unanimous throughout much of the bull rally. 2017 rather was a year in which that finally started to break apart. But numbers here are showing that even though active managers, the numbers we got from Morningstar and other measurements at the beginning of the year said that 54% of long managers, here's the numbers right there, large cap managers beat the benchmark, that's for Morningstar. 54%. But then you look at the flows for ETFs, 459 billion is what they estimated as of December versus 285 billion in 2016. So Scott, overall, the market here and investing community is still going to passive, despite the fact that this was a pretty good year for stock pickers.
Yeah, absolutely. I mean, again, a great point earlier they just made about being passive. It's great to have some of that skill set on the downside, right? But we've rallied for 9 years in a row, so you haven't seen the benefits of that. And of course, traders and investors are constantly bombarded by headlines of how passive, broad-based index funds are beating these high-paid managers. And this year, slightly, but it's still kind of the same thing we're seeing. So I think another thing we can take from T. Boone Pickens, just one other thing I want to add, is that he's kind of showing also the difficulty there is oftentimes in picking individual stocks. So if you're going to be active as opposed to passive in broad-based indices, you're doing a little more stock picking. And of course, then the impetus on you is to pick those stocks that actually perform. And obviously that can be difficult even for the highly paid managers. Yeah.
Victor, are you surprised by the numbers at all that if there's a move back towards active managers, it's not going to happen overnight, right? It's probably going to take several quarters of outperformance. We saw the BlackRock numbers this morning, and of course, iShares just continues to be a powerhouse. Is this ever going to change, or has the ship already sailed, or is it just going to take, as I might wager, just a big sell-off in the market to get people back?
You and I talked, actually it was a group discussion on Market Close earlier in the week, and we talked about how BlackRock might be the sleeper store going into Friday. Everyone was focused on JP Morgan from a headline perspective and Wells Fargo, but we cited this exact reason that we had seen these ETF flows increase into the end of the year. We had talked about it all of 2017, and that could be a catalyst for their earnings going into Friday, and we certainly did see that. I think it was an interesting earnings day altogether, but to your point around active versus passive, you're absolutely right that, and this goes along with all of the robo-advisors, all of those things. It's very easy to be a passive manager in a 9-year bull run, as we're approaching it. But what are you going to do when the VIX is not sitting at 10? When we're not hitting all-time lows in the VIX, when we're not seeing just rotations, when we're actually seeing money move out and we're actually seeing people go to cash, that's going to be a very difficult scenario. Now, it's hard to even envision that happening. That's certainly not the case today. Certainly as we're trading towards the highs again. This is the 9th straight day out of 10 days that we've seen the market move to the upside, and we've seen all-time highs all day essentially being made in all of the major indices. So it certainly doesn't look like that, but any sort of move to the downside, it starts to get people thinking, hey, maybe I wasn't so smart. I could have picked any stock and I would have done well. what are you going to do when you have to manage risk? And that's a big question for people.
Right, and the sector point of it, because remember, T. Boone Pickens' fund was basically an energy fund, and so poor guy got into a tough sector going into this 9-year run.
A lot of falling knives there you're tempted to catch. Bob, is it just going to take a bear market or more to get people to say, oh, well, I got to think twice about just being what I would phrase as Michael O'Rourke from Jones Trading calls the blind buyer?
This is my favorite thing. If I walk into this room, you guys don't know me, 3 smart guys, market experience, and I say, I've got an investment for you. I want to make you about 6 to 8% every year, but then about every 9 years, I'm going to get about a 45% crash. You're not going to invest in that. That's the S&P 500.
Yeah.
And so that's passive investing. It's really, really great because people see their retirement accounts. They're like, I got X amount of money. And then if your retirement date is in that 45% collapse, like 2008,
right,
all of a sudden you don't have as much money. So yes, it's going to take a big crash for people to understand there's 2 types of investing for as long as we've been alive for a reason.
Does it mean when the market does get a big downturn that the pain will be more pronounced than a market in which people are hedged?
Generally, yes, because most individuals don't hedge,
Yeah.
right? They don't go that far with it. They're passive.
Yeah.
They're just blind buyers. Again, it all depends on when your retirement date is as to whether it was good for you or bad for you.
And a report this past week, I believe it was from Bloomberg, that people are now taking off any existing hedges. Hedges were the lowest going back, I think, throughout the bull market. So it seems that obviously things are getting pretty bullish. Along that line, there's also a number here for flows that if guys who want to bring it up because this is basically a big picture flows number for equities overall that speaks to the bullishness. So far in this first quarter of the year, numbers have been big. Big numbers going into domestic funds, $24 billion in the first week of 2018, Bob, going towards mostly passive funds, but it generally, forget the passive versus active, this is just the overall number, Scott. Clearly, this move so far this year is getting people pretty jacked up about stocks.
Oh, absolutely, and of course we have the seasonality factor, right? So right after you get into the end of the tax year, oftentimes we see lots of funds coming into the market, so that's not unusual. I think it's also unusual to look at the breakdown of this because I know over the last few years there's been a lot of talk about money going into ETFs versus mutual funds, and there's sort of an ongoing battle there. I don't know if we've quite hit the point now where it's almost 50-50, but we've seen a lot of those investments going into ETFs as opposed to the sort of traditional mutual fund.
Vic, are you worried about the excitement in the market yet?
Well, I'm an options guy, so I'm always worried about worried about the potential downside. But I think one of the interesting statistics, and you guys did a great job of highlighting it there, $6.5 billion in the U.S. in terms of inflows, $4.5 billion in emerging markets. And in 2016, we knew that that was a turnaround year, and 2017 actually eclipsed the performance we saw in 2016. So if we continue to see growth in the U.S., we can continue to see it in other developed nations. We're also seeing it in emerging markets. That's been another interesting area that probably is not getting a lot of headline attention.
Bob, what are people missing through all this? Is it just maybe diversifying beyond just the FANG, trying to pick up some of the stuff that's beaten up like people have been doing in the retail energy space? Or are they doing the right thing to just kind of say, hey, you know what, this market, earnings look good, let me just take that broad approach?
I think this whole theme that it can go on forever is what everybody's missing. So all of us know that's not the case.
Right.
So one of the things that we've always taught people to do is to kind of slowly not only re-diversify or reallocate, as you guys would say, in money management, but to kind of take some of the chips off the table as it gets that high. Give up some of the upside that your neighbor is bragging about.
Right.
We know that from cryptos as well as stocks. Give up some of that upside to have that downside protection so that you can outperform. And when the stock market drops 45, you're not dropping 45.
Dow Jones led the way. We know that industrials were big on the day. Bob, we're talking about airlines leading the way. Does it make sense, Bob, that airlines keep rallying despite higher oil?
Sure. I mean, the portion of jet fuel that comes out of a barrel of oil is only about 10 gallons. So not that that matters, but it doesn't jack up the price of jet fuel as much as you would think, number one. Number two, $1,000 bonuses for everybody. So
that's what I'm saying.
Trips.
If the economy is driving oil up, then economy can drive airline prices up, right?
They can stomach it. They've hedged, especially companies like Southwest, especially have done a really good job hedging.
Yeah,
that's the big key there. That it's
they learned their lesson from previous rallies.
Right.
Yeah, it's a third of airline expenses, so it is a big deal. But the point is, they've had an opportunity to get in hedges around that $40, $45 level. So
and the curve is such that they can still do it because the curve is back to contango, which is the normal shape of the curve, and the overall price is so high that they can hedge out for months and they're still okay.
Out maybe if you look about 12 months out in the curve, it's still right around 60, a little bit under, so it's still a discount to where we're seeing the market right now.
Yeah. So basically, there's the big economic picture, there's the hedging picture, and then there is what could be potentially a competitive landscape here that's benefiting maybe some more than others, but overall the airline rally, as we were just talking about with JJ earlier, and Vic and I talked about it yesterday too, it's been pretty broad-based. I mean, those gains there are pretty impressive. But I wonder, Scott, this is a group that is, as I was talking with JJ, just think about it anecdotally and logically, right? When you go to buy a ticket, you see all these airlines in the same place. They're competing for the same consumer. They're using the same methods to get to them for the most part. But does that mean that they can all move together, or are you going to have to pick winners and separate from losers?
Within that group, I think, yeah, you'll see a little bit of divergence, but I think it's going to come down to being a little more tactical maybe than they have in the past. Because you're right, they're all feeding off the same inputs, right? Mm-hmm. Price of oil and things like that. And we've seen a lot of their gains over the last couple of years have been done and made where? Yeah. Billions of dollars made through extra fees, right? So we've seen a lot of activity in the fee side. I think it's
price per passenger,
exactly,
right?
Right. Baggage fees, all sorts of other fees that go in, and we're all quite aware of what those are.
Right.
So again, I think there's going to be a lot of attention focused on where they're going to go with that. Is that something they're going to continue to try to look at for increased revenues?
Vic, when we figure out who does better in this sector for 2018, is it going to be about who spends the money the smartest, who spends the money in the right way? Is it going to be about CapEx? I mean, we saw the Delta, those earnings here. It looks like they're going to have a little extra cash on their hands, guided up revenue, beat the earnings that they estimated for. This may not just be about, gouging customers at this point. It might have to be about something more, substantive. Yeah.
Yeah. If you look at the airline space, there are some differences between the spaces. Southwest, for instance, they don't rely really on a lot of upcharges that you'll see with United, Delta, and American. They probably get 30 to 40% of their revenue from those extra incentive charges, whether that's baggage fees or upsells on the actual plane. So there's some differences there. The other big difference, in particular, is domestic versus foreign flights, right? Yeah. Southwest is more concentrated within the U.S., and because of that, there were a lot of questions in 2017 around what a more protectionist policy would do to tourism within the United States, and that's why you didn't necessarily see some of the underlyings like United, Delta, and American participate to the upside as we saw with Southwest earlier in the year. Now that normalized into the end of the year, but there are some interesting questions going into 2018 as well.
Yeah, definitely. Bob, let's talk about a sector here that has captivated me. Retail, because you saw the big bounce back the last quarter. Then we saw numbers from specific companies that, even though they were positive, some of them held better than others on the price gains afterwards. Today, we're getting some kind of final numbers here, right? November and December, more than 5% gains for retailers from the Retail Federation, and the numbers here are pretty good. They're better than a lot of what these specific companies are saying, and overall, this looks like the best growth, going back pretty far. So, is it justified? Is the move justified?
I think so. I mean, 4.2% for 2017 is a big number. It was 3.2 in 2016. That's a big jump, a percentage jump for retail, especially in this environment of diminishing bricks and mortar, less time spent at retail, but maybe more time spent on retail. Again, the tax cuts, which, whether they're short-term or not, I think we'd all agree just technically that they are short-term in nature in terms of the gain for the, say, middle-class consumer. That is 2018. That is short-term. So you looked at consumer discretionary today. It led, you broke it down, and it was e-commerce and it was bricks and mortar led that particular sector. I think it's justified in the short to medium term, and I love what Walmart did. I really do. Walmart has said, basically, we're competing with Amazon.
Yeah,
we're shutting down Sam's Club. We're putting up e-commerce distribution sites from some of those stores. We're in.
Yeah, I learned a good lesson, which was the sort of investors' fall, because I was talking with a few of them that were talking about that longer-term outlook for some of these big companies about transitioning, closing down, the underperforming stores, turn them into distribution centers. Now, that only really works for a couple big companies, but if Walmart does it, you might see it elsewhere with what they're doing with Sam's. Go ahead, Scott.
No, I was just going to say, in this space, I think you're also getting into the point now where we're sort of getting into this rally for a while, and we're starting to see a little bit of who the winners and losers are in that space. I think the numbers today reconfirmed what we've been seeing. We saw e-commerce sales up 1.2%, but actual department stores down 1.1%. So within this moving higher sector, there are winners and losers. And I think, as investors, if we kind of look into that and do a little bit deeper dive, we can maybe gain some insights, because take a look at what is is performing well, the housing market. So look inside that retail number. I think I wrote some numbers down. Furniture was up 0.5, building materials up 1.2. So we're definitely seeing pockets within retail.
And the trade after the retail sales number this morning was incredible. We were up maybe 6-7 points in the S&P 500. We get both retail sales, CPI around 730. We're now trading negative down to, I believe it was 27.66. We're now 21 points higher than where we were about 735 this morning. So the trade today was incredible.
You know, Victor, I like that because the numbers from the retail, the economic retail sales, it didn't do much for it. It was about, some of those numbers that Scott was walking through, the November and December, 5.7%. The year, as you pointed out, Bob, a little bit lower. However, all right, so I'll play the bear here because not all retailers obviously are created equal. We know that much. But a retailer cannot live on the holiday season alone too, right? I mean, this is about bringing people in. Now, perhaps less discounting we did see this quarter than some, but I'll give you an example, Bob. Signet Jewelers was on our top 5 movers the other day because it was down big time. It was down 4.5%. 2 out of 3 of their main jewelry lines had posted year-over-year holiday sales that were lower. It's basically gotten all that gain back on nothing about Signet, just on this news here. Does that make sense?
You know, I mean, a rising tide, right? I hate to use cliches.
But that's got to be opportunity.
Can we change it? A rising tide lifts all.
Is that an opportunity for traders?
It is. I mean, you don't just want to go blindly. I think everyone would agree. You just don't want to blindly buy the underperformer. You'd have gotten killed on Goldman Sachs all last year if you just blindly bought the underperformer in financials. You don't want to do that. But yeah, moves like this happen. Momentum happens. If people decide to go into retail, people will buy the underperformers. At the end of the day, more buyers brings the price up. I don't know that it holds. But if retail holds, it's probably not going to give back much of it.
Yeah. I want to talk a little, we got to do it. Victor, I know you're excited for it.
We're going to currencies. We're going to talk about the dollar, right?
Friday crypto talk.
Not that currency.
Friday crypto talk. Because we're talking GBTC, right? One of the ways to invest, the Bitcoin Trust, okay? Now, this is emblematic, I feel like, of what a lot of people will say reeks of .com era exuberance. And really sort of, opportunism, if you will, because they're doing a 90-to-1 stock split. Not 2-to-1, not 3-to-1, 9-0-to-1, Scott Connor. All right, so I'm a young guy here. I was around during the .com bubble, but I wasn't, managing my downside and, managing my risk. Does this remind you of anything, Scott? Is this a red flag, or, is this just making it available to people to trade on a cheaper level?
Oh, it certainly could be, and I think there's people in the camp that have been in there for a while. They're not just joining today based on this news, but you can see what they're doing. They're taking a $1,700 stock, trying to bring down to about $20 a share so that more people can get involved, right? They just want to open up the floodgates, and we know that customers are already chomping at the bit.
And well, we know that one of the biggest factors here, it feels like in the past month, has been people that want crypto just go wherever the dollar amount to buy something is cheap. All that capital is flown from one coin to the next. What do you think, Victor?
You would come to me on this one. Okay, here's what I think. I think the cryptocurrency space as a practical use, we talked about this, Kodak the other day. There are some very interesting use cases and some real reasons
what about
to get
this
I'm going to get there.
Is it nuts?
There's some real reasons to get excited. No, it's not nuts. You've seen that. I think what's nuts is that we're not seeing it on traded companies like Amazon and Google to get participation in their underlying stock. It's nuts that we're not seeing it on stocks that people have participated in, even in the face of their high stock prices. So no, I don't think it's nuts that you're going to see a 90-to-1 stock split on something like this so more people can participate. But I think this is all about speed to market. They have been out there for a while. This was the first one out there. Now with futures out there, it's going to let a lot of other BlackRock, the iShares, anyone else out there participate on a more institutional level, and I think this is about getting there a little bit first and making sure that this, people can participate in the name.
You don't think they've got FOMO? They see people buying up cheap altcoins. They say, wait a minute, Bitcoin was supposed to be the hot thing. What happened? My analogy, Bob, has been...
I like what you had to say about Bitcoin and its potential position over the long term in the space.
Yeah, Bitcoin to me is MySpace, and there is a Facebook. Blockchain is transformative technology in the same way that the internet was. The comparison is not cryptocurrencies to the internet bubble. The comparison is blockchain to the internet, Bitcoin to MySpace. Bitcoin went from a launch in 2003 to being sold for $540 million in 2 years, 2.5 years. 27 million users, down to virtually nothing. When was the last time you checked your MySpace?
Hey, and correct me if I'm wrong, I think this GBTC is tied exclusive to Bitcoin.
It is.
Right? And so if we don't know who those winners in this space are, you're tied to a stock that is literally tied to just one.
Right, and
one
Bitcoin
crypto.
is doing the same thing with that MySpace did. They're growing too quickly. They're giving a poor user experience. It's almost the exact same sort of case between the two of them. There are cryptocurrencies that will be accepted. They'll be accepted by countries. They'll be accepted by retailers. Bitcoin did not rally on usage acceptance, on more usage.
Rallied
it
on
rallied on more
speculation.
participation in trade.
Rallied on
and this
people
goes
wanting to get rich
against
quick.
what sort of the cryptocurrency purists want. It's now Wall Street, quote unquote Wall Street, Main Street, driving it up, and the original Bitcoin purists are supposed to hate us. So it's just very, this Bitcoin trust has to become a cryptocurrency trust, or they are pets.com.
So I want to bring up something that I saw on Twitter today by someone addressing the GBTC split. And basically what they said was that, if we can pull up the tweet, guys, if we have it, it's basically the idea that there was no reaction that might have followed logically here, which was, if they split, then that makes it more available, rather when they split, that makes it more available to people to trade it on the cheaper dollar amount. This is from Dividend Master. He says, with GBTC doing 9-to-1 split, expect to see Bitcoin soar because retail will pour in to buy GBTC. But that demand didn't show up there. So what I responded to this was, that might make sense, that logic might make sense if people were buying Bitcoin for the reasons that the bulls would say to buy Bitcoin, Bob, but that's not why they did, and that's not why they are. And I would say the analogy is, I like kind of the social media. I'll see another one. Bitcoin is now old news, okay? The young generation that sent it way up to 20K is now elsewhere. It's kind of like, not to muddle the Facebook analogy, but it's kind of like, I'm not using Facebook because my grandma is. I love you, Grandma. But, it's moved on, okay? Bitcoin is Facebook, and, Ripple is Snapchat.
That's a good one, actually. That's really good.
You like it?
I do like it.
and not to jump in with a more liquid product here, but the dollar, just keep in mind, the dollar did take out those September lows, and the euro currency, we had been watching that 122 handle, given the information we got overnight from the ECB, and given the information we got out of Angela Merkel with that with the Grand Coalition. We've now taken out those 122 highs in the euro currency as well. So there are some interesting areas, not only in cryptocurrency, but in actual currency, certainly huge moves, the dollar down 1%. You talked about it earlier.
Hey, and a reminder, just to people on the stock split, going back to it, remember, it doesn't increase the value of your shares.
Of course not.
You just own more of a cheaper stock. Just wanted to make sure we're all aware of that from the trading standpoint.
All right, there we go. Victor Jones, co-host of Swim Lessons. Scott Connor, the Director of Trader Education here at TD Ameritrade, as well as Bob Iaccino. Bob, always great to have you, Founder and Chief Strategist at Path Trading Partners.